What if I told you that one of the most powerful forces shaping the economy isn't a line of code on a stock exchange or a policy decision made in a marble building, but something happening right now, inside your head? We think of inflation as a dry statistic, a number on a news report, but beneath the surface of supply and demand, there's a far more powerful and unpredictable force: human psychology. Our collective beliefs, fears, and expectations about rising prices can become a potent, self-fulfilling prophecy. This is the world of inflation psychology, the recognition that the economy isn't a machine, but a complex system driven by the emotional and often irrational minds of millions of people just like us. So how exactly do our thoughts create economic reality? At the heart of it is a simple feedback loop. When we, as a collective, believe that prices will continue to rise, we change our behavior. The logic is simple. Why wait to buy that new car or refrigerator if you expect the price to be thousands of dollars higher in a few months? It feels smarter to buy it now. This buy now mentality creates a surge in demand across the entire economy. More money starts chasing the same amount of goods and services, which, in turn, pushes prices up. The fear of future inflation literally creates that inflation. It's a prophecy we fulfill ourselves. Businesses are part of this loop too. If a company anticipates that its costs for raw materials and labor are going to increase, it will preemptively raise the prices of its own products to protect its profit margins. This creates a domino effect. And this brings us to the most infamous part of this cycle: the wage price spiral. As you and I see the cost of living go up, we demand higher wages to keep up. When we get those raises, our employers may then raise their prices to cover the increased labor costs. This leads to us needing another raise, and the spiral continues upward, a cycle that can be incredibly difficult to break. This isn't just a theory. It was a key feature of the Great Inflation of the 1970s, where persistent inflation became so ingrained in the public's mind that it fed on itself for years. This power of expectation isn't limited to rising prices. Look at Japan, which for decades has experienced the opposite problem: deflation, or falling prices. This has created a deflationary mindset. When people expect prices to keep falling, they delay purchases. Why buy today what will be cheaper tomorrow? This suppresses spending and acts as a constant drag on the economy, proving that our collective expectation of price changes, whether up or down, has profound and lasting effects. But why are our minds so susceptible to this? It's because our brains aren't perfect calculators. We rely on mental shortcuts and cognitive biases to make decisions, and these can lead to systematic errors when it comes to money. Let's look at 4 key biases that shape our personal experience of inflation. First, there's anchoring bias. This is our tendency to rely too heavily on the first piece of information we receive. When it comes to inflation, our anchor is often our past experience. If you remember gas costing $2 a gallon, that price is anchored in your mind. Today, even if your salary has significantly increased, a price of $5 a gallon can feel like an outrageous ripoff. This creates a feeling of financial anxiety, even if our actual purchasing power hasn't changed that much. After a long period of high inflation like we saw in the early 2020s, people can become anchored to those higher rates, continuing to expect high inflation even as it starts to come down. This makes it much harder for policymakers to cool things off. Second is loss aversion. Psychologists Daniel Kahneman and Amos Tversky discovered that the pain of a loss is about twice as powerful as the pleasure of an equivalent gain. Losing $20 feels much worse than finding $20 feels good. In the context of inflation, we experience a price hike as a loss. When the cost of your coffee goes up by 50 cents, that feeling of loss is more powerful than the good feeling you might get from a similar increase in your hourly wage. This is why small price increases on everyday items can generate such strong negative reactions. It's also a key driver of the wage price spiral. The fear of losing ground financially is a powerful motivator to demand more pay. Third, we have the availability heuristic. This is a mental shortcut where we judge the likelihood of an event based on how easily examples come to mind. When it comes to inflation, we tend to give more weight to price changes that are obvious and frequent. The prices of gasoline and groceries are the classic examples. We see them change constantly, making them highly noticeable. A sharp increase in the price of gas can make us believe that overall inflation is out of control, even if the prices of many other things, like electronics or streaming subscriptions, are stable or even falling. The media amplifies this, with headlines about soaring prices making those examples even more available in our minds, which can skew our perception of what's really happening in the economy. Finally, there's herd behavior. This is our tendency to mimic the actions of a larger group. In finance and economics, this can be dangerous. If people see others rushing to buy goods in anticipation of price increases, they're more likely to do the same, even without thinking it through. We all saw this with the great toilet paper and hand sanitizer shortages of 2020. A small supply concern, amplified by herd behavior, turned into empty shelves and panic. In financial markets, this can fuel asset bubbles, as investors pile into stocks or real estate simply because everyone else is, driving prices to unsustainable levels. These psychological forces aren't just academic concepts, they have shaped history in dramatic ways. The most harrowing example is the hyperinflation in Germany's Weimar Republic in the early 1920s. As the government printed money to pay war debts, the German mark's value plummeted. At its peak, a single US dollar was worth over 4.2 trillion marks. Life savings were wiped out overnight. People would get paid and literally run to the stores to spend their money before it became worthless by the afternoon. This national trauma left such a deep scar that it's often cited as a key reason for modern Germany's deep cultural fear of inflation and its focus on price stability. More recently, Zimbabwe in the late 2000s saw a monthly inflation rate of nearly 80 billion%. Confidence in the currency completely collapsed, and people abandoned it for US dollars. It's a modern reminder of how quickly public trust can evaporate. In the United States, the Great Inflation of the 1970s marked a major psychological shift. For the first time in a generation, Americans began to expect high inflation as a permanent feature of life. Unions demanded cost of living adjustments in contracts, and businesses raised prices without hesitation, confident their competitors would do the same. It took a deep, painful recession, engineered by Federal Reserve Chairman Paul Volcker, raising interest rates to extreme levels, to finally break this inflationary mindset. So if our psychology is such a powerful force, how do you fight a feeling? This is the central banker's dilemma. Increasingly, they realize their job is not just managing numbers, but managing expectations. Their primary weapon has become communication. In recent decades, central banks have started using what's called forward guidance. This is where they openly communicate their future policy intentions. By signaling that they are prepared to raise interest rates aggressively to combat inflation, they try to reassure the public that they have the situation under control. The goal is to anchor our expectations. If we believe the central bank is committed to keeping inflation low, we are less likely to panic and demand huge wage increases or rush our purchases, which helps prevent the self-fulfilling prophecy from taking hold. However, this is a delicate art. Central bank messages can be complex, and there's always a risk they'll be misinterpreted. And in the age of social media, where misinformation spreads like wildfire, it's harder than ever to get a clear, nuanced message across. The recent global surge in inflation following the pandemic has introduced a whole new generation to the anxiety of rising prices. For many, it's a rude awakening. The big question now is whether this was a temporary blip or the start of a new, more inflationary era. The answer depends heavily on psychology. Has this experience left a permanent scar, making us more sensitive to price changes and quicker to demand higher wages? Or has it served as a lesson, reinforcing our collective desire for price stability? The rise of technology and social media adds another layer of complexity. We are bombarded with information, making it easier for sensationalism and fear to shape our views. But it also offers central banks new ways to communicate directly with the public. In the end, this journey into inflation psychology reveals a profound truth. The economy is not a machine to be fine-tuned with technical levers. It is a complex, dynamic system of human interaction, driven by our collective hopes, fears, and beliefs. By understanding our own mental biases, the anchoring, the loss aversion, the herd mentality, we can become smarter consumers and investors. And by recognizing that our shared mindset can shape our reality, we take the first step toward building a more stable and prosperous future. The economy, after all, is us.